A warm welcome outside there to our next webinar here at JFD Brokers. Yeah, my name, as always, for those kind of webinars, Stefan Friedrichowski, and of course, especially in the English one, you just can call me Stefan. Even if you get in contact with me, you see already my email address. No problem. Just do not hesitate and write an email to the shown email address. Yeah. So that already said, a warm welcome, by the way, in the name of JFD as well. Today we have the 26th of July, 2000 and what do we have? 18. Yeah, and today was EZB interest rate decision. Most of you will know. I not, because I have been surprised, and you know that I'm not really directly related to news and or even news trading. Always the same question: do I stop my expert advisors during such events? And the clear answer is, as always, no. As today, but I realized later that there has been at least something, but nothing major, as we all see in the charts. But we have that kind of event every 2 months, so it's always not a real surprise. Okay, today's topic is pullback trading strategies. The one or the other might know what pullback trading means, or therefore we will introduce that, of course, in much more detail. And the one or other might remember that we have done something similar already when we talk about real stock trading. And indeed, you're right. It's quite similar what we do today, but today we will do it on Forex. Even in principle, that kind of strategy is quite good on indices as well. And later in the webinar, I will show just an account which is trading same strategy on indices. The email address, once again, you might need, if you want, later I will show a couple of Excel sheets. And if you want to have access to those, just drop me an email and I will make sure that you get all the Excel sheets we show here. Oh, now I realize that I forgot to already to show up the PDF document. Maybe I can do it as we speak. So that we can have those as well. So let me try to do it. But you have to know it's always difficult to here to speak and do the right mouse clicks as I speak here. But let's do it. So I show the other slides in a second here. We talk about trading strategies, and therefore I have to show up on the risk disclaimer. You know that whenever it comes to your own trading activities, of course, you do those trading activities on your own, and you know that I have to say that within every webinar. But anyhow, I think it's self-explaining, and now we have the PDF document of today's slides already uploaded, so you can download those in the GoToWebinar control panel. A little bit more in detail what we do and the following. So we really start with pullback strategies from a definition point of view, and we will do it a little bit untypically. We will really do it in a chart later, than that we all know what we are really talking about here. When I mean pullback trading strategies, and later you will see that I even go a step further. It's not only trading pullback, it's a combination of pullback and even so-called grid approach. Grid approach means that we not only work with one trade, we even go for trade sequences, and how to deal with that even in Excel. We will discuss as well. Yeah, so it's two kinds of strategies we combine here, and that's quite good tool to go for such strategies in general. Of course, we do it in Excel here once again, although you know that finally when it comes to those strategies I really trade, I have one additional step that's so-called C programming to get it a little bit more robust and to have that walk forward methodology. But I will show the results for those pullback trading strategies here within the webinar. And it's I think the fourth time in a row, more or less, that finally I have as a last topic and now as a portfolio, because we have a good approach, a trading strategy, and a trading approach called here pullback. And yeah, we don't have to stick to one underlying. Why not going for couples of underlyings, really nearly everything you can trade, and combine all those strategies into one? That's diversification on the one hand. And finally, what we need for really good portfolios is diversification of underlyings and strategies. But for me personally, it's always one strategy trading a couple of underlyings, and that is finally what I call one strategy or one trading account, because I always separate the strategies on different accounts. But what do I mean with pullback? And pullback strategies in general, you may even come from a more technical analysis point of view. And you know, when it comes to technical analysis, or what in the German language we sometimes have a second wording that is called market technique. I don't know exactly whether there's a good English translation for that. But what I mean here is, if you think about a typical upwards trend, and that is characterized by higher highs and higher lows, and you may go, if you go to a textbook, then you will see, okay, a very good zigzag line going upwards. That's a theory. And then you call the increasing values, if it's really an overall increasing trend, an upwards trend, then you call that progression. And always the correction phase you call regression. And now when we talk about pullback strategies, you might call that regression phase. So when it goes down in an overall upwards trend, you might call that already a pullback, because yeah, price constantly goes up, but now for a certain time it does a correction to the south, and that you may call pullback. But in a little bit more general, you can even say, okay, even a return after a breakout. Think about price is flat, nothing happens all the time, and then all of a sudden we have a breakout, let's say to the south, and in a lot of cases, on a little bit longer period of time, price comes back exactly to where it starts. So, and that is a pullback as well. But let's have a look into the chart, because then it might be a little bit more obvious. So let's go for a chart, any chart we want. I have no idea which chart I should choose. Let's go for Australian dollar. Yeah, let's go for this one here. Okay. And later you will see that we do everything on D1. So I switch to D1 for the Australian dollar, US dollar here as well. And let me zoom in a little bit. Then it might become quite obvious what in general pullback trading strategies mean. In this case, you see, okay, we have a downtrend, no question. So price overall within the last half year went south. Okay, that's obvious. And even what I called, in this case, I need lower highs and lower lows is more or less confirmed looking to that period of time here. So you see we have a new low here, then a high, which is lower than the previous one, and so on and so forth. People who do technical analysis sometimes forget, okay, there are details which look a little bit not perfect. And for example, look for here where my cursor is right now. In this case, the new low is not lower than the previous low. But anyhow, we see a very good downside trend overall. Pullback now means, okay, we start here going south, and then we have a sequence of candles going up. So in this overall south movement, this phase here is called regression, and that is meant with the pullback phase, which we have right now here. So ideally, we would trade in that sequence here short, I agree, and ideally, we would open trades, for example, like here, or here, or even here. So that would be a good point in time to start those short trends, because immediately afterwards, we go really good south. As always, if I just talk about history, talking about half a year history, looking to that chart, everything might be obvious or clear, or how to call that. And you know, the detail is always later when it comes to real trading. But that is a principle of pullback strategies. Good. But we will go a step further. Let me step back to my slides. So we go even a step further because we want to go for grid pullback strategies. And grid trading, you might have heard this one as well, and maybe you have heard it's dangerous. Grid trading or grid strategies are well described by equidistant trade openings. Okay, what does it mean? Equidistant trade openings. It means, let's talk about DAX, for example. The DAX is at 12,000, and you may put a buy limit order at 11,900, and the second one at 11,800, and the third one at 11,700. You see what I mean? And we go in a distance of 100 points, and we place our limit orders. In this case, equidistant, which is not necessarily, it must be equidistant, but I will describe it that way. In most cases, strategies like that work quite well, but a lot of strategies like that do not have a stop loss. So that's nothing for us. Later you will see, but let's go in detail in the next slide. So what we do is we work with buy and sell limit orders on the base of the open of a candle. And what we do additionally is that we use an EMA as an overall trend filter. Let me illustrate this in the next chart here, because we don't go for several candles movements. No, we start always at the open of a candle. And if you look to that chart here, let me illustrate how we go with a pullback grid strategy exactly on my vertical blue line. So at, what was it? 14th of June 2018 for Euro Japanese yen. At midnight, the price opened here. It's a vertical blue line, and that was open of the day. So we are exactly here at that cross. And now what we do is we place orders. In this case, I virtually put only 2 buy limit orders here, but I may even go further in the same sequence. In my case, the sequence is simply 1 point. When I talk about 1 point, I mean the difference between 130 and 129 for Euro Japanese yen. So we would always 1 point below, we would put the next order. So you see the horizontal green lines, and that illustrate those buy limit orders. During the day, we have quite impressive red short candle here. And what you can't see anymore, that the price went down even below, further down than the close of the day. At that day, both buy limit orders would have been filled. So we would have two trades open at the end of the day. What you immediately realize, if you do always the same, maybe at the next day at the open, we place once again two buy limit orders, or even 3 or 4 or 5. You can see by your eye that those orders would not have been filled. But that is a principle. When the day starts, we place our orders. All not filled orders will be cancelled at the end of the day. So from MT4 perspective, we would use the expire functionality so that all not filled orders are automatically cancelled. And we repeat the step every day. Every day we do the same. We place our orders. When we know the open, then it comes to those buy limit orders. In that case, we will later see examples when we do it on the short side, but anyhow, that is the overall principle. You see that what I mean with the grid, and you see that we need a strong remove during the day so that our orders are actually filled, and that we repeat every day. You may ask, hey, what about stop loss? What about take profit? I explain. So in principle, many grid strategies work only with take profit. So there might be, for those trade sequences, you may have, let's go back to the DAX, it's easier just with numbers. Maybe you go with a take profit of 50 points or 200 points or whatever, and they only place the take profit for all the orders, and they do not have a stop loss. If we do long only strategy on DAX, of course, you can think it will be successful because overall the trend goes north, we know. But to have a strategy without a stop loss is in principle not acceptable for me. And therefore I even wrote down here for us. Nevertheless, there are hundreds of strategies going exactly that way, meaning they do those rebuys with a grid, and they don't have a stop loss. So they increase their position size, increase. And I put it in brackets here, but there's a name or a naming or phrase for those kind of trading strategies, and they are really called big ball strategies. I'm not sure whether everybody knows maybe exactly what really is meant with big balls. Let me explain that way. All listening men would know what I mean. And now I think everybody knows what is meant with that phrase. It simply means you reinvest to the final end. And maybe you need additional money into your account. And finally, you simply wait until your take profit is hit. That's all. But that's nothing I want to do here because I want to have a stop loss. And how do we do it? What we use is we use a fixed euro value, or you may trade in other accounts like US dollar or I don't know, but so a fixed money amount for the stop loss. And we use a fixed take profit in euros or in money as well. So today we are not going like percentage values or what we did, or we do not go in, okay, stop loss is always 20 bips below my entry. No, we go for a fixed euro value or money value for stop loss and for take profit. And the main point here is we do it regarding less what we have as actual size of our overall position. Overall position, I call those trade sequences, because let me start with an empty account, so with no open trade. And now we do the first rebuy, and maybe we buy one lot DAX, and then we do the second one, then we have two lots DAX, and then the third, three, and so forth, and so on and so forth. But now the critical point is that our stop loss, because I introduced the stop loss as a fixed euro value, will come closer and closer to our entries. On the other hand, our average entry price is getting smaller. That decreases, but the stop loss comes nearer and nearer, so closer and closer. And I like it because I want to have a fixed amount of money being on risk and not an unlimited risk. So what we have, if we do it that way, we have a real risk limitation. And that's what we need for professional trading. We cannot assume that later everything will turn out to be good. No, we need a risk limitation, and therefore we need a stop loss. And that stop loss will be calculated by the size of our open position and our fixed money value for that stop loss. On the other hand, we do the same with the take profit. So if we do our rebuys, for example, then our take profit will come closer to our average entry as well, which is good. Later you will see that within our Excel sheet, just because of technical limitations, that we have in principle for the one candle we are looking for, and we are placing our buy limit orders and sell limit orders, that if those orders are filled, that those will not have a stop loss and not have a take profit calculation wise, but only until the end of that candle. So let me be practical. It means that for maximum 1 day, all trades which are opened during that day, they do not have a stop loss or a take profit. On the other hand, if price really goes crazy down, then on the next day, of course, we will reach our stop loss, and if nothing really crazy happens, so that's okay. And the reason is not because I don't want to have stop loss. It has to do with practical limitations of Excel, because we can not do several actions within 1 day. So, but that's more just Excel reasons and not trading wise. So from trading, I still use within the day stop loss and take profit. Good. So what do we have in order to develop our strategy? And we will do it in Excel in a minute. We have, when we look to our grading pullback strategy, we have four. Oh, that's funny. There's a missing F. We have four degrees, 4 degrees of freedom. Maybe you are not that related to math, then you would call it parameters. Anyhow, what do I mean with those 4 degrees of freedom? We have to, and those 4 degrees of freedom, by the way, characterize our trading strategy. So we have a stop loss in euro for a certain trade sequence. We have a take profit in euro or money value for our trade sequence. Then we will have an EMA period, because let's think about, we have that upwards trend. So in this case, our intuition would say, if you have an overall uptrend, why should I place short orders in that trend? And in order to do so, we can use our EMA as a filter. So if price is above, if that open is above the EMA, perfect, then we only would go for long trades. And finally, our fourth degree of freedom, is the distance. Is that, and I will use simply a percentage value for our entries. So when I talk about DAX 12,000 points, first buy limit order at at 11,900, it would be something like 0.9%. So we would place our grid 0.9% stepwise. So those 4 degrees of freedom characterize our strategy. That's all. And before I jump into the Excel, let me quickly go back to our chart, our real chart. So this one. So what does it mean? Because I have one additional thing to mention when it comes to that EMA. So we need a moving average. Let's go here. Let's go for this one. And let me check a little bit that it becomes a little bit more obvious what we are doing here. So I go for a different EMA period. Let me reduce it to 100. It doesn't help. You see, it's like trading directly out of the chart. No, that doesn't help as well. So let me change the underlying just to make sure that it's becomes a little bit more obvious what I like to illustrate here. Okay, this one is good. So I concentrate on the last part, and you see why I'm not a fan of just looking to charts, because you manipulate always EMAs and stuff like that in a way that everything fits. You see, we are constantly here below that EMA, and of course it would be good to say only short trades, and that's exactly what I mean. And only at the very end of the chart we would stop placing by short sell limit orders. For example, this green candle. No, this green candle still we are in the race because the open of the candle is below. And at the next candle, we would be out of the race because that open is above the EMA, so we would not place our sell limit orders. And then we are back in the race, green one, back in the race, and over the next red one, we would be out of the race because the open of that candle is above the EMA. So that's a filtering process of an EMA. But now we can ask ourselves, okay, that's the intuition. Below EMA, only short trades. Above EMA, only long trades. But maybe it's better to do it vice versa. Maybe. We don't know. We have an intuition about chart technique, but maybe the real world is different. So in principle, we should be prepared to do it maybe exactly the other way around. So let's at least be open for that kind of behavior as well, that we can do it exactly vice versa. Why not? If it later turns out that our intuition is right, good. If not, even better. So then we have everything. But that's what we do with our EMA filtering process, that we only trade one direction for one particular strategy. Why do I call it one particular strategy? Because now for every underlying, we can look for 4 different strategies. We can look for a long strategy. So we just investigate our underlying for long trades. In the second step, we would investigate that underlying for short trades. Why not? So we do it independently. And it's good to do so, especially if you go a step further and you might go for indices here as well. You know that indices have a tendency to go north. So maybe it will turn out that short trades doesn't make sense. Maybe. Let's see. And so we have long and short trades on the one hand, and we can do it, use the same wording as in previous webinars. We can do it with reversal 1 or reversal -1. What do I mean? Yeah, exactly what I showed in this chart. Maybe we would say we only trade long if we are below the EMA. So we do it exactly opposite. And that is exactly what I mean with reversal -1. So it's finally, it means that for a specific underlying, we have in total 4 possible variants we might investigate. You imagine how many trading strategies we will finally have. If we do it for, let's say, 30 underlyings, we have 120 potential strategies. Wow. That's a huge portfolio. And that's what we are targeting here. So as I mentioned, we do everything in Excel, no problem. So let me switch to illustration-wise here. And now we have here the Excel sheet for that kind of trading strategy. And let me explain a little bit what I have prepared. And as I mentioned, you have access to that Excel sheet. Just send me an email and I make sure that you get everything. Let me guide you a little bit how the Excel sheet is structured. It's always starting, of course, here with historical data. And you know how to get them. And next point is simply to calculate that EMA. And we can turn those knobs. And with knobs, I simply mean all yellow marked cells here. So right now we would have an EMA period of 50, and we can change to any other value. The first question within the Excel sheet, and when I say first question, I mean within one row, is I ask the question, hey, is the open above or below the EMA? And as you see, in this case, the open is below the EMA based on the close of the previous candle, because that's the definition. We cannot use the EMA value of the same row because that's the EMA based on the close of that candle. But at the open, when we do our decisions, whether we trade, what distance for those limit orders, we have to decide on the open. Otherwise, we would include already the future in the trading strategy, which is never good. So in this case, we will not place any order. That's characterized by the zero here. And of course, we can now change with those green knobs. We can go for short trades only, and of course, then that -1, that 0 turns to 1. But we will start with this one. And you have maybe already realized that not everything has been reversed when I put a -1 into that cell. The reason is the following. I introduced our filtering process in a sense that I said, okay, let's stick with long trades and the normal intuitive behavior. Okay, long trades only if we are above EMA. Good. But only if there's no trade sequence open. If there's already a trade sequence open, we place even at the additional days our trades. And that's the reason why it's not symmetric here, because let me switch back to the 1. So you see there's no trade at the second line. There's no possible trade. And when I switch to -1, of course, here at the second place, we have now a +1, and for all the others as well. Why? Because now you will see that during the candle, our grid has been activated. So at the next day, we are on the other side of the EMA, but since we have a trade sequence open, we do further rebuys as well. Okay, so maybe you see if we change EMA period, things will change, and maybe we go for another one here for long short. And as you can see already, our picture of equity, which is shown here, changes. But let me first start with something which maybe looks a little bit strange. Just let me change the numbers a little bit more random here, so that we have something like a very crazy start position. Okay, so we have a close distance for our grid distance, and that is calculated here. And then the next step is we ask, is that grid activated? And if so, how many? You see later here already a 2. What does it mean? Yeah, exactly like my previous chart picture. There has been 2 orders being activated within one candle. And that's already illustrated here. And then what we do practically, we we do those buys always stepwise with 0.01 lot. So that is the fundamental logic within that Excel sheet. We open our trades always with 0.01 lot. If we fill 2 orders within 1 candle, of course, and it's a 0.02 finally. Okay, so what degrees of freedom do we have else here? So we have the stop loss value in euro, we have the take profit value in euro, and there's one additional thing we need in order to do all the calculations right. We need the exchange rate. In this case, it would be even more easy because we are looking for euro US dollar. Then we could take the price itself here as being the exchange rate. But later we will go for example, Australian dollar, Canadian dollar. If we investigate that underlying, okay, then we need the exchange rate for euro, Canadian dollar in order to do all calculations right. There is honestly one limitation. Normally we should use 2 data sources for our prices, but let's not do it too complicated. Last point to mention here within the Excel sheet, you may wonder because of commission of 12 euro. That's really a tough value. Why do I do so? Because I know that at GFD we have a commission of 5.5 euro. And why do I choose 12? Simple reason. Within this Excel sheet, we don't consider the spread individually. And in order to nevertheless do something which represents spread, I simply increase the commission, which is valid. And even a value of 9 euros would represent it correctly, because typically we have a spread of 0.2 or 0.3 bips, and we have a commission of about 6 euro, and that adds up to 8 to 9 euros per lot. Let's make it easy and be on the safe side. Therefore, I will go here for an even higher commission. But now back to our equity. What we are looking for is we have an EMA, no reversal. We go for a long only strategy, long trades only. And you see crazy equity line. That represents the sum of all trades which have been executed. And honestly, it doesn't look that good. But now let's first study the example of what I mentioned being big ball. So let me increase stop loss. You see what happens? Equity is perfect, as always, if you accept stop losses like that. So you see, in general, we can turn the strategy immediately into a perfect profitable strategy. What we are doing here is, of course, we are only looking to closed trades. So MT4 wise, it would just be the balance and not the equity. But anyhow, finally, the trades are closed, and yeah, that's our equity. That looks great. But you see what we need, and I have no idea how far I have to go down. Okay, that was not enough. Let's try with 15 already. 15,000 euro would be enough, and then we would never been hit by the stop loss. So everything is calculated within the Excel sheet, and I think you will realize how everything runs here. So, but now let's fine-tune this strategy again a little bit. So let's go for 500 euro stop loss. Then you see we are finally not really profitable. And by the way, what I do here is I simply calculate the slope of the equity, and now it's already minus, meaning we are constantly, or in average, we are losing money. So what might we do? Maybe it's better to increase the grid distance, which means we are not that heavily doing our rebuys. Let's increase to 0.7, for example. And you see, a little bit better maybe. Let me increase it further. And critically, let's go for 1.5. Oh, constantly going down. Okay, now let's change the EMA. Maybe to that value. It looks a little bit better, so we may need higher stop loss values, but not to that extent, maybe even going to the double value like this one. And now, okay, we have something. Let's check. Take profit as well. It's getting worse. So let's go for this way. You see, we have our 4 degrees of freedom, and we can do our optimization process for our strategy. And when we finally are done, we might even say, okay, let's look for a short strategy for the same. Oh, looks good as well. That's not always. But in this case, it works, and it works even better. But anyhow, it's not that straightforward to find the right parameters. So what we are doing finally is simply we are using a trick. And the trick is we do it, that kind of optimization process, direct in the standard Excel, because the standard Excel has so-called solver. And what that means is the following. So you see here just another example, like Australian dollar, New Zealand dollar. And you might already realize, hey, that equity looks better than the previous one. You're right. It turned out that for that kind of strategy, once again, those underlyings which don't have very good trend phases um, are much better suited for that kind of trading strategy than, for example, those with Japanese yen, for example. But back to the solver, what we are doing in order to get the best equity and the optimization process, we just go for the cell which should be optimized, and then we use that kind of Excel solver mechanism, and that means we identify, oh, I have to switch the screen. We have to identify what we want to optimize. In this case, the slope. Okay, and slopes should be higher and highest. So it should be a maximum value. And then we say which kind of cells we want to be changed, and then we simply click the button. Sometimes it needs a couple of minutes and until we are done, and then we get our optimization process done automatically. Great. And you see, that doesn't look that bad. And we can do now the same for the other one. So that is a short trades for Australian dollar, New Zealand dollar with a pullback strategy. And now we can have a look for long trades as well. Okay, looks good as well. And now let's change the underlying once again, Australian dollar, Canadian dollar. And here, okay, still we have two drawbacks here within our equity, but nevertheless, if we do it for a couple of underlyings, it turned out that we get an enormous portfolio of strategies which we can trade. That's brilliant. Let's have a look of what we can achieve if we are doing this for really lots of underlyings. What we can achieve is an overall portfolio. And those results I want to share with you here as well. Let's first start with the equity, which we finally get if we do a strategy with that kind of technique. That's a combination of several 10 sub-strategies of different underlyings, and we don't need anymore that high stop-loss values like shown in the Excel. And what I have done here is even going for that walk-forward methodology. Let me remind you what that means. We do an optimization, for example, for data of 2004 until 2006, and then we do that kind of optimization process, and we apply them in the following year. And that's all. That's walk-forward methodology. So we do optimization process applying in the future. And then all the future trades are summed up, and that is this kind of equity. And still, it looks quite promising overall. Unfortunately, I don't have a calculation which I called simply brute force for all, for the complete period of time. So you have to do something by your own, just filling those Excel sheets and finding the best parameters for the optimization process. But finally, you will get something similar to this one here. That I have done it with walk forward methodology is, for me personally, simply a confirmation that it really works, and it works quite brilliant, as you can see here. Let me show you how that works specifically. So what does it mean if for the parameters we get? Oh no, that's not this one. It's this one here. So right now, as we speak, the current parameters I use for that strategy are the following within the table here. Let me enlarge it. So you can see we have targets for those trades ranging a couple of 10 euros. Stop loss values for those trade sequences are in the range of 100, maybe 200 euros. And you see the buy limits in a distance of maybe 0.5% away. So there's one line with really strange numbers, means you see there's no optimum found. So we skip that underlying and we will not trade that one. Maybe later, a couple of months later, it will turn out that we can restart trading here as well. But right now, trading on that specific underlying is stopped. But as you can see, out of the 35 different sub-strategies, it's only one where this trading is right now actually stopped. So those are the actual parameters. If you like, if you want to do something similar, you can use those. As I mentioned, you can have access to that Excel sheet. Sorry, wrong wording. Let's go one step further. We can do even better. And you may already imagine what I mean because of my yellow marked cells. So if you go for that kind of portfolio, we can do additional steps. I can just simply call them variants here. Since we have quite impressive big universe of Forex pairs, why not do one additional filter process? And that filter process is simply, let's only go for those with positive swaps. Why not? So it will reduce our trading activity, but since we may go for trends which last several days, okay, let's only trade those which have positive swaps. That means when the next day starts, we get something on our account and we do not have to pay. And that's brilliant as well. So we simply reduce our trading activities because we are reducing the number of underlyings to those which have been yellow marked in the previous Excel sheet. But still we have lots of underlyings and we earn those positive swaps as well. That's good. So that's variant one. And the other variant we can use is that, for example, if you go for indices, why not limit our trading activities to long trades only? Since we know, as for the stock trading, overall it goes north, why entering short trades? We can still have lots of underlyings, and why not going long only? Because we know that we have a fundamental bias for indices going north. Let me show you the results of that in a real trading account. And that means, no, not this one yet. We have to jump here, and then we have to jump here, and now we go for that trading account. So what we are doing here is trading exactly that kind of grid strategy, long only, filtered by an EMA. And without going in all the details, what you can see right now, there has been a long sequence of trades for the index of Hong Kong, but actually we don't have any buy limit order. On the other hand, what you see is you see those grids of orders being active, but none of them is activated during the day. Overall, we have only open trades with UK, the UK index, and with the Nikkei index, and that's how it looks as we speak. But let's look for the equity as well. So because that account is already running since, let me look, running since here we are, since November last year. So it's quite a long time already that this one is up and running. And let's go for a detailed statement, meaning simply that we create an equity curve of that live account. So that is those 10 indices being traded in that live account. And yeah, since I'm running the strategy on a server, it takes a while until we get the result, but it will pop up hopefully in less than a minute, only in seconds. And here we are, we have all the trades of that account, but I only want to have a look here on the equity, and it looks like this. It's quite impressive. We have already close to 10% earned with that kind of strategy. Of course, we have those drawbacks within our equity, and we have an even more pronounced one here, and that was exactly the mentioned trade sequence on the index of Hong Kong. But anyhow, looks good. So it's really good to have that overall bias within that strategy, and that bias is simply the long bias. So it's worth to go for additional bias and to go for indices long only to the one end, and the other possibility just to select further down all the pairs and go only for those with positive swaps. Since I realize that a couple of people are coming right now into the webinar, I hope that that the webinar starts already at 7 p.m. German time. Anyhow, let me say two things as we speak right now. The recording will be on the JFD YouTube channel, so you can listen to the beginning of the webinar if you want from tomorrow onwards on the JFD YouTube channel, and that's exactly the keywords you have to press at Google. And you can already download the slides in the GoToWebinar control panel. And if you want to have the Excel sheets, which creates exactly those kind of strategies, you just send me an email, and you will see on the next slide my email address once again. Okay, so those subvariants like here, swap positive only and indices long only are quite good and already shown in a live account. So finally, because I'm now at summary, so for those who just jumped into the webinar, in a nutshell, we have seen pullback strategies. They are quite useful, and we know how to do that kind of trading activities by those limit orders on the sell and on the buy side. We use an EMA as a trend filter for that, so that we distinguish in which direction we want to trade. The most important thing for me personally for those kind of strategy is that we use a stop loss, and that means we tame that kind of strategy. Otherwise, we end up with what I call the big ball strategy, and that's not the one I don't think is professional. We can improve further by our variance. So we go for only for the positive swap forex pairs, and we go for indices long only, and that is further improvement of that kind of trading approach. So if you want to have those Excel sheets, as I mentioned, here now once again my email address so that I can send you those Excel sheets. Yeah, that's already for today, but I can already announce how it goes further on. And in August, because exactly today I put everything together. So next time we do once again a little bit about how do you to derive a trading strategy from a more statistical point of view. That will be really interesting. We will talk about throwing coins. That doesn't sound like a trading strategy, but you will see that we use that kind of technique or comparison, better to say, in order to derive some specific deviations when it comes to real stock prices or real forex prices. And the other one that is even more surprise, hopefully, for everybody, I will show you how to follow all the strategies we developed within those webinars quite easily. But that's still a little bit of a secret, and that will be at the end of August. But you would definitely see already email announcement before, and that will be a good step further. I can promise already. So that's for now. Hopefully enjoy once again, and I hope that you will be around for the next ones as well. So it will be middle of August and end of August. So I think the first one is in 3 weeks, and the other one then in 5 weeks. But during the next couple of days, you will get that kind of announcement, or you will find those webinars on the research page of JFD Brokers. That's for now. Enjoy the evening. I assume it's hot at your place as well. In Germany, it's still, I don't know, around 30 degrees. Yeah, that's now. So I can only say goodbye for today. Enjoy your time. Bye.